Patrick and Maddie Gergen, thanks for joining me here.
Thank you for having us, Patrick.
Thanks for having us.
So we got some ground to cover. We want to know what's going on in Texas. There's basically 4 questions we're going to try and answer today. Not going to try, we are going to answer. And that is, what are you seeing in the market in Dallas right now? And what types of financing are you looking at based on the current market? And where are you seeing, or what are you seeing for opportunities as we move into the future in that particular market? And how are we able to lower investor risk in this economy? So American Alliance, what are we seeing in the space, and how is it that you find yourself in Dallas, and why are we in Dallas as investors?
What we're seeing in Dallas right now actually is growth everywhere. Even surprisingly, we're even seeing growth in office space. There's 2 big towers. I'm in our apartment in Dallas right now, and there's 2 huge, massive towers that they're just digging dirt right now to build office space, and they're saying it's going to fill quick. So we're seeing growth everywhere. Just outside our apartment here, we can see a development space where they're building a tower there for residential. So still a lot of businesses are moving in, huge immigration, a lot of opportunity for growth still, and we're super excited about the future here yet.
What is it behind this, Patrick or Maddie? Maybe Patrick, you have the answer that you can speak to in terms of, you talk about immigration or in-migration, people moving into Dallas. What is driving that particular market right now when you look at GDP growth, population growth, employment? Texas as a whole is certainly known for oil and gas, but there's lots of confusion around even that and what's happening given some of Biden's initiatives. So what is driving that market? Do you have some insights that you can share about why you see that as a sustainable market given that growth?
Yeah, absolutely. One thing I always like to remind everybody is when you look at all 50 states are really competing against each other. And with all competitions, you've got some net winners and some net losers. Well, Texas consistently has been one of the net winners, and especially the larger cities like Dallas and Austin, San Antonio, and Houston. And so the beautiful part about it, and to your point earlier, it's extremely diversified. So there's a lot of companies that are moving from a lot of these other states. And the reason that they're moving to Texas is because they like how business friendly it is. And then people move here because they like that the cost of living is still very, very affordable. So there's a lot of jobs that are moving in, but then there's also a lot of jobs that are being created because as they're bringing in different companies, office towers are coming up and hotels are being built, and then new restaurants are being put online and gas stations. And it's just really creating just some wonderful job growth, top 5 in the nation consistently. And it just creates a really nice, really good investment atmosphere as well.
Well, let's just talk a little bit about investment. You and Maddie have got lots of things going on in that multifamily space. You've recently launched a fund. You've got an existing building that you've got really great track record behind it. Give me a little bit of insights into what you're doing in that multifamily space before we carry on. I'd like to hear a little bit more about what it is that you've got and what you have happening, given what's going on in Dallas.
Well, like Patrick and I, we don't just depend on the market. So we always implement a forced value add plan. So yes, we've got Bella Vista Point is one of our buildings here in Dallas. It's 188 units. And so we're seeding that into the fund. Now that building has what's called a forced value add, which also helps us with alleviating a lot of the risk. Number one, we've owned it for 12 years. It's a complete sale, and then a repurchase. But we're doing, 109 of the units. We're going to do a premium renovation, increase the rents between 125 to 175. Wow. We've tested this in the market, which will significantly increases the value of the building. So the more the higher your rents, the more income that's coming into the property, the higher the value of the building. So it's a 3 to 5 year deal. And, so we do different things. So it's not just a premium renovation. We're also going to put in smart home systems and alarms, which also increases the value. We're going to put in covered parking, larger yards. So basically that's how we help to, increase value in a market that maybe, could have some slowdown, and you don't want to just, depend on that market.
Well, I mean, something you said that kind of stuck out with me. I mean, it all did, but when you're talking about getting the kind of rental increases that you're talking about on 144 units, was it?
There's 109 units more we're going to do. Yes.
Yeah. So, but the point is that, I mean, that takes, that improves the cap rate dramatically. And, when you look at how that comes down on your NOI, I mean, the actual values of that building goes up, what, millions? I mean, it's got to be a pretty dramatic shift in terms of valuation. Am I on track there?
Oh yeah, you're on track. It literally goes up millions. And the beautiful part about doing that is, like, to Maddie's point, we completely rebrand these properties. We're going to take it from a C property, C+, and we're going to convert it all the way into a B property. So not only are you going to get additional rents for the premium units that you've remodeled, but because you've elevated the entire property to a B class, every single rent is going to go up substantially more across the board. So nice returns.
So that's fantastic. Now, tell me a little bit about the lending environment. I know that given the US, I mean, there's been bank collapses. And as we do this, I think there's another one that is about to or has already started. I mean, is the lending environment tightened up? What kind of financing are you able to kind of bring together in that kind of marketplace right now? Have you been at the effect of that?
Yeah. So, over the last few years, a lot of people were looking at bridge financing. That's not the market that we're looking at right now for financing. So we're looking more at like agency debt, which is government-backed debt. We're seeing some that, will do 35-year AM. Patrick and I, we can get discounts because we're in the affordable housing space. Also because of our social impact programs and green programs, we can get some discounts on that. So that works well for us. But yeah, we're looking more, 5-year term, over 30 to 35 years agency debt like Fannie Mae or Freddie Mac right now.
So when you look into the future, I mean, so you've got this potential, and I mean, really strong potential for growth in this particular building. And then as you see into the future, I mean, you see opportunities specifically in Dallas, or where are you expanding to, or are you expanding outside of that, or are you just going to stay really focused on what's going on in Dallas?
Boy, Patrick, the fundamentals are so good. We're going to stick to Dallas for a while. There's certainly some other strong markets, but one of the big advantages that we've got is we're completely vertically aligned. So not only do we self-manage, we have our own property management company because nobody cares like the owner. We also have our construction company. And so when people are talking about labor shortages and just different things like that, and we've never been affected by that because we have our construction crews as well. So it just really adds, and it's not a profit center for us. The construction side just really makes it so you can get your projects done on budget, on time, and you're not in that precarious position like a lot of the other people are that do value adds.
Yeah.
It's an interesting time, isn't it? We were talking a little bit off camera where I'm seeing, especially in Canada, working with thousands of investors across the country this many years in, we start to see where apathy grows and where nervousness grows. We talk about FUD, fear, uncertainty, doubt. Seems to be so many global issues and so much negative press, as there always is, by the way. When you look and say, well, how do we talk to investors in a way that we look at it? You've been at this game a long time. I've been at the game a long time. I've worked with investors, as have you. We see these times as opportunities, whereas most less sophisticated investors, they want to go in at the height of the market when all the hype is there, all the excitement is there, everybody's getting rich being a real estate investor. And at a time when things are in fact uncertain is where the opportunities exist. So at the end of the day, we know that investors are looking to say, well, how do I mitigate risk? So I automatically look at a scenario like this and go, this is a way to mitigate risk, as opposed to buying, the bricks and mortar yourself and going in on a small multifamily. This is a way to kind of spread your risk out and even diversify and kind of open up the opportunities for putting your capital to work in different containers, if you will. So when you talk about lowering investor risk, how do you see it in this economy, or how do you see it within this fund or within the work that you guys are doing?
I think we'll both have answers to that question, because there's a lot to encompass in that. But I do want to start by saying, like when you were saying, people are shying away from buying right now, and I guess that's the last thing Patrick and I are going to do right now. And also, 2010, 2011, when we started buying here, believe me, nobody was buying here at that time. And we started buying, and we bought as much as we could at the time. And, investors, the few buildings that we sold in 2020, investors got 26% returns IRR over that 10-year period. So they did amazing. And so that's the one thing that we absolutely don't fear away from. And in as many years as we've been in real estate, for the two of us, we're super excited now. Things are we're starting to see opportunity. So basically, there were, the market was on fire here. Over the last few years, people were buying at the top of the market. They were buying with bridge financing without rate caps. So basically now their mortgage payments are double. So they're struggling with those. So in those challenges becomes also some opportunity where we can help them, to be able to get out of that situation. So we are seeing some of that happening. We're definitely hearing about it out here. We meet with a lot of people when we're out here. And so we're seeing huge opportunities coming forward. So we're not going to stop. No way are we going to stop. This is what we've been waiting for, Patrick. And Patrick, I'm sure you have some to add to that, because I didn't really answer Patrick's question.
I mean, it's such a big one, right? Because it's like Warren Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1, right? It's so important. And you want to be able to compound your money. So we say, look, we've got 5 really important points. Number 1 point, we're in the state of Texas. We're in Dallas. So we're in a very, very good market. Number 2, we're in multifamily. It's a great market to be in. Everybody needs a place to live. Number 3, we're in workforce housing, because they're just not making it. When you look at all these units that become online with new construction, the majority by far are for luxury. So they're not building workforce housing. There's a constant, huge demand for workforce housing. Number 4, we do value adds, which is really, really important, because then it doesn't matter what the economy is doing. When you really look at our financials, most of the money's made in our value add than just, banking on the economy. And then the 5th one is we're vertically aligned. We've got our team in place. We're the asset manager, property manager, construction manager. And through all of that, we're able to really navigate and do very well in a variety of markets. So it doesn't matter if it goes up or down. We don't stop buying. We just change the parameters that we buy, and we continue to put our 5 points into action and make money.
And we're more shorter term now, Patrick. So we're more, the 3 to 5 year plan, whereas previously we were, a longer, like 10-year plan. So that's also part of it.
Yeah.
Well, I think that there's one other that I would add, from my perspective, outside looking in, and that is that in this particular case, you're talking about a building that has a multi-year track record that you guys know intimately. You actually even know your clients / your tenants intimately, and your management team knows them. So I think when you look at risk mitigation, there's a 6th point that you can't step over in this particular case, which is a building with a track record really speaks to where this can go and how well you know that particular building and buildings and where you can take it. So I think that's a huge one in terms of the risk mitigation conversation. So as we